Chairman of the Federal Reserve Bank, Bernanke, yesterday gave markets a first direct signal that quantitative easing was approaching its end. Despite this being reflective of improved economic activity in the US, the markets across the world have reacted violently by selling off. So why the negative reaction, and should investors expect more volatility going forward? Eben Marais joins us from Stanlib to discuss these questions. Thanks so much for your time. Well, you would think that the market would celebrate. This is good news. It means that the US is on a firmer footing, that we can remove some of this excess liquidity, but it means that the market has been artificially boosted then by all this excess liquidity. Is that a fair assessment?
Yeah, Bronwyn, if we look at the statement that Bernanke actually made yesterday, he said that we view the risks to the economy as being the downside to the risks as being lower, which is a bullish statement. So the markets, as you say, should be celebrating. The downside was that he's saying that, look, we could actually be pulling back quantitative easing a lot sooner. And obviously that's got a direct impact on currencies, it's got a direct impact on the bond market. You've seen the long end of the yield curve, the 10-year treasury in the US selling off. You've seen the South African bond market getting smashed out of its socks today. I mean, at one stage today, we were down 50 basis points on a yield basis. That translates to about a 5% price move, so which is significant.
Even we've seen the gold companies come off. Yeah. We've seen the gold price go down. I mean, this is the way I see it. We had the patient in 2009. Yeah. He got onto the medicine. He liked the medicine, and then when the doctor says you're getting healthy and the medicine's being withdrawn, the patient's protesting. I mean, why does this not make any sense to me? I just can't understand why the markets have just sold off left, right, and centre. It's been currencies, commodities, everything.
Yeah, I think it's this.
There's no place to hide, in other words.
No place to hide.
Yeah, there seems to be no place to hide at the moment. I think everybody's been driven by the cheap money, the flow of money, the wall of money. But today also we've had the Chinese PMIs coming in at a lower level. There's some cash squeeze concerns in China at the moment as well. So it's not, in my sense, just the US driving things here. So there's also China growth concerns. And obviously those impact on the South African market to a much bigger degree. Also on the China basis, you know, if you're seeing less demand for commodities, you can see how that spills over into the gold and precious metals, for example.
Where to from here? Are we going to see more downside, more volatility?
So the thing to remember here is that they've not taken the stimulus away. That's actually the bottom line here. If things deteriorate, I can't believe that the Fed's going to say, look, we threw all our money at this problem for a couple of years and we're just going to walk away. They're still sitting in the background. What the Fed
so
has
that safety net is there?
Absolutely, the safety net in my view is still there. What they have said that is if the growth continues the way it is, we will taper quantitative easing. But if it actually starts falling back, they will still be in the background. So the market's got a proper scare now. I think he was more hawkish than anybody had anticipated.
And that's probably the reason why the markets reacted so violently. But even still the idea that he might be withdrawing. How easy is it actually to do this? Because Japan seems to be constantly throwing liquidity. The Greenspan era, they called it the Greenspan put. Every time there was a problem, you throw money at the problem. It's almost a case of anytime something goes wrong now, we're going to see massive amounts of liquidity coming into the markets. How easy is it actually for a developed economy now to withdraw it?
I suppose if you think about it that way, what they did last night was the logical thing, is to say, look guys, you can't actually always expect us to be there in the background. And we've got to start withdrawing. What you've also got to bear in mind is Bernanke's term is coming to an end. So he's got to, in a sense, prepare the market for that. On the other side of the coin, if there is really a blow-off in the market, if that long bond actually starts selling off dramatically, you're going to see a bit of panic and fear in the market. You've seen CDS spreads actually starting to move out, which is a bit of a warning signal everywhere. So this could turn into a contamination.
Are you nervous at the moment?
I sense that there's a lot of volatility, and I think at the moment you're going to see a lot more volatility come before things abate. But I think we're actually in a spot which we've all probably been bracing for this to happen. I mean, every time you've seen quantitative easing come through, people have said, my goodness, can you believe that bonds are again down? And so we've probably been waiting for this. So we're not nervous, but I do think it's a time where you're going to have to be careful with your investments, and you have to believe in protecting your capital, which is something that we stand for very strongly.
Even you've mentioned it there, and I think Bronwyn alluded to it a little bit earlier, but the question of people, investors specifically now having to make decisions around this. A lot of turbulence today, and you expect more volatility going forward. People that are planning for retirement, people that are planning to put money into the market. You run the absolute return franchise at Stanlib. I mean, today I think there's not many sectors that were up. What would your advice be as an absolute return architect or advocate around how you manage? Because this is not going to happen overnight. It's probably going to be 3 to 5 years, perhaps, or at least 3 years that they're going to withdraw this. Where does this leave an investment strategy and clients that need to make decisions around entering or exiting the equity and fixed income markets?
It's a very sound question. So what's extremely important here is you've got to bear in mind that you've got to preserve capital. And I think that's something that you've got to look at. So the one tenet of our investment strategy is protect capital. The other thing, obviously, you need growth. So what we try and aim for is to have CPI plus 4, 5, 6% on a growth basis. You achieve that by being invested in a multiple of asset classes. So that's a combination of growth type assets. You've got to be in equities, property, commodity type thing, but on a protected basis. So in other words, you do everything that you do, but it's protected. So that you can't lose capital, but you still participate in growth. The other side of the coin, you do look at fixed income, but you look at it on the basis where you don't have exposure to longer duration, for example. You're seeing at the moment, as we said earlier, that the long end of the yield curve is blown off. And you might see a lot of volatility there. That makes me nervous when yields, which are a much bigger market than the equity market, actually start behaving with a 5 or a 6% move on a daily basis. That makes people nervous. And you should expect a lot more stability there. So you should expect that you're positioned in the shorter end of the curve where you've got a lot more stability.